Hello everybody. In this video we're going to take a closer look at the open economy loanable funds model, and we're going to get some insight and also some application. Let's think about our first application, the impacts of higher U.S. interest rates on emerging market real interest rates. And we often think of this as an event that took place last year. We call it the taper tantrum. As a little bit of background, you probably know that since the financial crisis and the recession of 2008 and 2009, interest rates in the United States and in other industrialized countries have been at record lows. Investors have been responding by taking their money, searching for return, higher rates of return, putting their money into emerging markets. We've seen that market participants from industrialized countries have been supplying financing for emerging markets. So this has meant that many emerging market countries, they've kind of, let's say, enjoyed life. They've enjoyed low interest rates, and their highly appreciated currencies have made them feel rich, and this has permitted them to purchase imports far in excess of their exports. So they've been running substantial net export deficits. Now this started to come to an end in May of 2013 when Fed chairperson Ben Bernanke, he was then the Fed chairperson, announced that the days of low interest rates would likely end soon, that the Fed would begin to taper some of its asset purchases, and that as a result, some global interest rates rose immediately. So we can use our open economy loanable funds model to tell us what the implications of this rise in interest rates would be for emerging markets. So I'm looking at the spreadsheet now. You can see that initially we have, under both alternative 1 and the baseline scenario, the same interest rate, and we have over here an equilibrium exchange rate. So now we're going to assume that the external real interest rate rises 100 basis points from 3% to 4%. And you can see what happens. As the real interest rate rises, savings is encouraged, investment is choked off. So we have a new lower savings investment balance, and that's reflected over here in the shift of this gold line from the solid gold line to the dotted gold line. And you can see that along with a lower trade balance or net export deficit, that is to say more exports, less imports, we have a less valuable real exchange rate, a real depreciation. So let's summarize our results. An increase in world interest rates will mean a movement from the baseline to alternative 1. Residents of the small open economy will now save more and invest less. Foreigners are now willing to provide a lower amount of financing than previously. The real exchange rate depreciates and the deficit on net exports decreases. Let's go to application 2. And we're going to learn about here a fiscal expansion and in an economy that's considered to be sound and safe by global investors. The government is increasing its expenditures without correspondingly increasing taxes, or alternatively it's cutting taxes. Either way, public savings is falling. This is going to mean, if we go to our spreadsheet, here we have a situation where we start off with the baseline, and we start off with alternative 1, the same as the baseline. The interest rate is the same, and public savings now declines, and we're going to assume that it declines by this amount. This is going to mean a leftward shift of the green savings line. We're now going to be saving less, but because the interest rate has stayed the same, that means that our investment is going to stay the same, because foreigners have agreed to provide more financing than previously at the same interest rate. So this decrease in the savings investment balance is going to be reflected over here by a leftward shift of the gold line from the solid gold line to the dotted gold line. This is going to mean, of course, a higher net export deficit, lower net exports. It's going to mean more imports, less exports, and it's also going to mean, because more money is coming into the country to finance a higher net export deficit, we're going to have a more appreciated real exchange rate. So let's summarize what we just learned here. A decrease in public saving, what we call a fiscal expansion, shifting the green savings line to the left. This is going to mean that total domestic savings declines while investment remains the same. Why has this happened? Because foreigners have passively agreed to provide even more financing than before at the same interest rate. So investment now exceeds by savings by even more, and the net export deficit is even higher, even more imports and even less exports than before, and the real exchange rate has appreciated. It's now more valuable than before. But now let's pause and think of a question that you might have been asking yourself. We might think of when a country's currency appreciates, that's a sign of its strength. A stronger country, a stronger currency. But isn't a higher government deficit, lower government saving, isn't that a sign of weakness? How do we reconcile this apparent paradox? Higher value for the country's currency with the weakness revealed by less government saving? Well, one potential answer is that the country is well run, or alternatively, it could just be lucky. Investors believe that even though the government's budget deficit is increased, the country is still sound, it's not risky, and investors will still believe that they'll be paid back, and that's why they continue to provide financing at the previous interest rate. Well, that leads us to application 3, a fiscal expansion in an economy that is not considered to be so sound by global investors. Back on the spreadsheet, we can see the same scenario, but now we're going to add a new shock. And the shock is now that our interest rate is going to rise, and here it's going to rise from 3% to 4.5%. So now you can see the piling on of shocks. Not only do we have our previous leftward shift of the savings function, but we also have a higher interest rate. On the savings end, that's going to shift us along this green dotted line. So now savings is going to be a little bit higher than it was in the previous scenario, although still lower than in the baseline. But the important impact here is in investment, because higher interest rates are going to squeeze out investment. And this was such a substantial increase in the interest rate that the savings investment deficit is now lower than it was in the previous scenario. And that means we're going to see this shift of the savings investment balance from the solid gold line now rightward to the dotted gold line. This is going to mean a higher net export balance, lower imports, higher exports, and it's also going to mean a less valuable currency, a real depreciation. So let's summarize here. In this scenario, what's happened is that investors have gotten spooked. They see the country running higher deficits and they say, this country is risky. They need to be compensated with a higher interest rate than previously to finance the country's deficit. We often call this an increase in the risk premium, and this often is associated with a downgrade of the country's credit rating. So in this example, the real interest rate has risen so severely that net exports now increase, we're going to have a lower deficit, and the real exchange rate depreciates. So the big picture here is that as a result of this higher government deficit, global investors, they've been spooked. They're taking their money out of the country rapidly. They're not providing as much financing as they used to. Effectively, then, when we have higher government budget deficits in an open economy, this is going to bring on higher interest rates through the risk premium that are going to squeeze out investments. We've added a little bit of realism here. Here's a story from Bloomberg, although we have changed the name of the country to protect the innocent and also the name of the president. But this was a case where a formerly creditworthy country was cut to junk bond status by Moody's Investor Service. Why? Because it has failed to rein in its widening government budget deficit. So here are your key takeaways. The open economy loanable funds model helps us understand both the trade balance and the real exchange rate. All else equal, for a small open economy, a decrease in the external interest rate will mean higher net export deficits, more financing that's provided by foreigners, we call that higher net capital inflows, and a more highly appreciated real exchange rate. Higher government deficits can mean large net export deficits and a more appreciated currency, but that's only that provided that external markets continue to provide the same amount of financing at the initial interest rate, and that they have continued to maintain confidence in the country. And we looked at a case where in fact investors get spooked and they regard the country to be a risky proposition because its deficits, its government deficits, have increased or its government savings have decreased. Thank you very much.